What is going on, traders? Huge day in the stock market. CPI report came out today. Unless you were hiding under a rock or didn't watch our live, you know that the CPI report came out today. As I've been tracking all along, I've said that coming up on this trend line, if we get CPI that is in line, we will likely break this trend line on the SPY. And yesterday, I posted on my Twitter, I posted what the expectations for CPI were, and I said that I think that we are actually going to come in as expected or better than expected, and we did. And I know that the numbers are fudged in a way that makes them look better, blah, blah. But within the context of that fudging and within what we know about CPI, right, it's still analysis, and there is still analysis that you can base plays off of. I also said that the put-call ratio was still above 1, so shorts were likely to get burned. And if you look all over Twitter now, you were seeing people who went short here at this trend line when I said you should be careful here, are also getting burned because the put-call ratio is so high that we are seeing massive short squeezes. And you have to keep in mind that a lot of institutions have not done any buying, and so they are now doing their buying. There are a lot of shorts. The buying propels those shorts to close, propelling even more buying, right? This is a classic short squeeze here. So we will get into the markets, where I think the markets are going, why the markets rallied this violently, what did the CPI data actually uncover, and why did the market rally this violently? Also, it is reported that your buddy, Michael J. Burry, has actually closed his shorts at an estimated loss of 40%. Now, this is being reported by some publications. I haven't seen it reported, internet-wide, like on Bloomberg or whatever, but it is being reported by some, and I actually trust the source, Gergevin, on Twitter or on X. He said that Michael Burry closed his shorts for a 40% loss. So we will get into that. Let's start with the CPI report. So the CPI report came in. You could see here that the CPI report came in 0.1% better. Now, there was one metric here that really caused the CPI to absolutely skyrocket, and it was because it was estimated that headline would come in at 0.1% month over month, but it actually came in at 0% month over month. Inflation was flat in October from the prior month. Core CPI hits 2-year lows. So that zero number was psychological, because remember, as I stated in my Twitter post, again, follow me on Twitter for daily free trading and finance content, same as Instagram. I post daily on both of those platforms. But what I said on my Twitter was 0% month over month headline expectations. Inflation came in at 0% month over month. So big psychological level there. Year over year came in 0.1% better, and the core came in 0.1% better. So as you can see here, it says core CPI rose 0.2% and 4%, whereas the expectations were 0.3% and 4.1%. So core came in better, and month over month inflation came in flat. So that is the reason that the market, one of the reasons the market skyrocketed. But another reason, which was actually one of our plays here, two of our plays were dependent on this, was the fact that if CPI came in line, then we would likely see bond yields tank. And if you take a look at the 10-year, it is down 4% today. This is the biggest percentage down, I think, in this whole rate hiking cycle, by the way. Since March of 2023. Okay, not in this whole rate hiking cycle, but the biggest percentage down this year. We did have a 5.8% down back on Friday, March 10th, 2023. So this is the second biggest jump down in the 10-year, right? Which means that bond prices absolutely skyrocketed today, as you can see here, which also means that because bond yields tanked, the dollar tanked, which means that gold actually skyrocketed today. So if you look at gold, which was one of our plays, you can see a big green candle. So we actually bought bonds and we bought gold yesterday and the prior week. So you can see here my play on gold sent yesterday right before market close, talking about the fact that I think the dollar is going to tank due to interest rates tanking, due to CPI coming in line. Closed most of the contracts for $2,350 per contract. I traded gold futures. Some people traded GLD as well. and I'm still holding on to one contract, hoping for a continuation. And I also sent out on November 8th my thesis on bonds and why I'm going long bonds. And like I said, bonds absolutely ripped today. Another thing that I went long on November 10th, you can see the date here, I went long on IWM because of the disparity between small caps and mega caps was the largest disparity in history. And as you guys know, I love to buy the extremes. That is when the biggest opportunities are had. And here's my analysis on the S&P 500. I said the S&P 500 is still stuck at the trend line, even though I think if CPI comes in as expected, it will eventually break this week. And break it did. Look at this massive candle on the S&P 500. And by the way, if you want access to all of my plays, all of my options trades, futures trades, our commodities trades like gold and oil, as well as my treasury plays, right? If you want my trades on bonds, my long-term stock analysis, my long-term stock alerts, make sure that you click the link in the description. Take advantage of the holiday sale right now. And make sure that you register for our free option selling mastermind on November 19th at noon Eastern. Make sure you sign up. You will not be able to get this any other way unless you're on this list. So make sure you sign up for that. All right, so where do we go from here? I think that this is clearly not a fake out. As I've been saying all along, we are still in a bull market, and this was a correction of the bull market. We got a nice 10% correction, which is what you can ask for when you are bullish. You want there to be a nice correction. I was hoping we'd get a little bit more so I could buy lower, but 4,100 was my main buy point, and we got all the way down to that level on the S&P 500. I don't think this is a fake out. I think that we will continue until we get to at least July highs. The NASDAQ is a lot closer to July highs, about 2% away. S&P 500 to get back to July highs has about 3.5%. So just a little bit shy of the NASDAQ. But I do think that we will eventually get there, you know, even if we pull back a little bit here. Man, the Russell 2000, what a day. 5.35% day up. This might be the biggest day of the year on the Russell 2000. And like I showed you, we just bought into the Russell 2000 because of that extreme divergence. So super happy about this one too. But yeah, I mean, I do think that the S&P 500 will get back to July highs by the end of the year. Remember, we have two big events now until the end of the year. We have NVIDIA earnings on November 21st, and we have the Fed on December 13th. The Fed can obviously ruin our entire party here. The Fed can come in and raise rates. I don't think they will, but they can ruin our party or they can ruin the party if they did that, right? Although I think they will pause. Now, the reason that we rallied so hard is not only because inflation came in lower than expected, according to the way that they calculate, but because there's now an insinuation that the Fed is done hiking, that the Fed's level of 5.25%, right, around that level, in terms of the Fed funds rate, that we are done hiking and the Fed is now going to just hold it higher for longer and then cut later in 2024. That is the insinuation. If they don't raise in December, they are never going to raise. That is what I think. Now, I think there's a hope that the Fed gets back to some sort of easy monetary policy too, right? Now, the reason that they would pause is because obviously the narrative now is that, hey, a soft landing is possible. We can get to the Fed's 2% goal without breaking the economy. Obviously, that's never happened before. I don't think that's going to happen. But that is the hope, right? And also the hope is that we get back to easy monetary policy. So that either involves bond buying again, which I don't think the Fed is ready to do, but I do think the Fed is ready to pause, and I do think they'll be ready to cut by next year at some point, either half of the year or, you know, on the back half of the year. So I recently just sold some calls against my SPY shares. I sold calls against my Tesla shares, and I sold calls against Tesla. Wow, Tesla up 6% today. This is unreal. We just closed all of our cash secured puts here. I had the 195 puts expiring November 24th. I had the 215 puts and the 220 puts expiring December 15th. Closed all of these for massive, massive profits. And like I said, Tesla, again, you know, was a buy. One thing, if not anything, one thing I am with you guys is honest in how I see things, right? So for me, Tesla was a buy below 200. When it got below 200, everyone was telling me it's going to 50. You're an idiot for buying. And I'm just like, keep insulting me, man. I would rather buy stocks when they are down rather than buy stocks now. Now, what questions am I getting? Obviously, is it too late to buy? Is it too late to buy the SPY? Is it too late to buy Tesla? Is it too late to buy this? Guess what? It wasn't too late when Tesla was trading at 195. And I don't care. Tesla can go below 195. I still would think it's a good buy, right? The SPY can go below 410. I still think it's a good buy. It would be a good buy if the SPY fell to 390. 410 would still be a great buy, right? So when I see the discounts, I take them. That's how I approach investing. If there's a major discount on a blue chip that I really want, then I will buy it. Anyway, traders, that is it for this video. I personally would not short here. I personally would not long here. For me, I'm in these positions. I'm either going to sell options against my shares or I'm going to ride it out. If we decline further and we get to one of my buy points, then I will start adding. If we get to July, then I'll be, July highs, and I'll be a happy camper as well. I will likely add to my bond longs after the Fed, after December 13th. I will likely add to my bond longs for sure, because in my view, I do think that bonds are now longable. And I do think that there's a great opportunity for bonds when the stock market might not see a ton of growth past this insane rally that it's had, right? If we only have 3% or so left until we get back to August highs, I do think there's an opportunity in bonds, not only at capturing, 4 or 5% yield, but I do think bond prices will also rally as well, giving us exponential gains on bonds, at least higher or more optimal gains than the stock market is giving now after this enormous rally, right? I think that's where the next opportunity is. Anyway, if you want access to all of my plays, link is in the description below. Also, take advantage of that holiday code. Also, I'm thinking of live streaming more on YouTube, like either 3 times a week or on a daily basis. I don't know what schedule I can keep to. I never thought about it before. I only live stream the major events, but I've been thinking of doing regular live streaming. So let me know down below if you'd be down. Either leave a thumbs up or leave a comment, or both. Let me know if you'd be down for that, because I'm really thinking about doing that. Sign up to the free option selling mastermind November 19th at noon Eastern. Hopefully you got something out of this video. If you did, leave it a big fat thumbs up. Leave it in the comment section below what you think is going to happen. Is this a fake out? Are you invested? Are you sitting in cash? Are you in puts? Let me know. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.